You want to own a home. It is a fantastic goal. But right at the starting line, you face a major obstacle. You probably do not have the massive pile of cash required to purchase that house outright. To even step onto the board, you need an entry token. In real estate, this is known as your deposit, or down payment. This chart shows how that entry token breaks down, typically requiring 10 to 20% of the total price. Looking at the rest of the chart, a massive gap in funding obviously remains. But that initial deposit is mandatory. It acts as a show of good faith to the seller, and it proves you have a baseline of financial stability. That deposit is your critical entry fee. It proves you are a serious player, allows you to bypass the need for total upfront cash, and officially starts your journey toward buying a home. To cover the remaining 80 to 90% of the house's cost, a new entity steps in, the bank. They cover the gap through a specialized long-term loan called a mortgage, which you will pay back over the next 15 to 30 years. Because the bank is risking hundreds of thousands of dollars on you, they will not simply hand over a mortgage. They need to run a strict audit. They check your specific stats. They look at your history of job stability. They examine your credit score to see if you pay your bills on time, and they verify that you actually have the funds to cover that initial deposit. Passing this rigorous audit results in pre-approval. This is the official green light from the bank. It means your funds are locked in and you are finally cleared to go house shopping. Securing a mortgage is a strict partnership. It is entirely contingent on your ability to prove past financial responsibility in order to secure future funding. During the house shopping phase, you look around the market until you locate the perfect property. Once you find it, you submit an official offer to the seller. But other buyers might want that same house. When demand is high, multiple buyers will submit escalating offers in a bidding war or auction. Everyone shouts out higher bids, driving the final price of the home up. Once your offer is accepted, you have to decide how you will pay the bank back. You will be paying the original loan plus interest, a mandatory convenience fee the bank charges for letting you borrow their money for decades. You face a split in the path. Option 1 is the fixed rate. This path provides perfect predictability. Your monthly interest payments remain exactly the same for the entire life of the loan. Option 2 is the adjustable rate. Here, your interest payments are tied directly to the economy. They can unpredictably rise or fall over time, much like riding an elevator that suddenly shoots up or drops down. Choosing your interest rate is the most critical strategic decision in homeownership. You have to balance the long-term safety of predictability against the immediate risks of market volatility. You have your loan and your house, but before you get the keys, you must survive the final stretch, a rapid-fire trap of closing costs. These are a series of upfront, out-of-pocket fees. First are the appraisal and inspection fees. You pay professionals to verify the home's true financial worth for the bank and to physically crawl through the space to check for hidden physical damage, like termites. Next come the legal fees, title searches, and recording fees. This money ensures all contracts are legally sound, puts your name on the government deed, and confirms the seller truly owns the home they are selling you. Finally, the government takes a bite with transfer taxes. The bank may also require mortgage insurance if your initial deposit was thin, adding one more layer of security for their investment. A home sticker price is an illusion. You must hold thousands in extra cash reserves to survive this fee gauntlet and take possession. Reaching the house is not the end of the game. The moment you move in, a massive 30-year timer begins for paying back the banker. This 30-year cooldown comes with powerful long-term benefits. Making consistent, on-time mortgage payments steadily increases your credit score and builds deep financial trustworthiness. Beyond credit, real estate offers a specific path to wealth, appreciation. Over several decades, the house's value will likely grow, often allowing you to sell it for significantly more than you paid. But the risks are severe. The literal translation of the word mortgage is death pledge. You are legally bound to an immense debt burden that lasts for decades. If you fail to make your payments, the bank can trigger foreclosure. This is where they exercise their legal right to step in and take the house back. A mortgage grants you immediate access to a massive asset you couldn't otherwise afford. In exchange, it legally binds you to decades of strict financial discipline to actually keep it. Navigating a home purchase requires months of preparation and a deep understanding of the financial stages involved. Understanding the core rules, from securing those early deposits to navigating the hidden fees at the end, is the only way to successfully survive the board. The game of homeownership is long, expensive, and fraught with risk, but playing strategically is the proven path to building lifelong wealth.